Okay, dear students, first of all, welcome to everyone in today's live revision class. Okay, let's start from the queries in which head we will find the past paper solution. So let me on the portal. Recent past paper questions answer you can find in the recent Kaplan kit. I think that is already shared in your WhatsApp group. If you don't have, you can ask in the group. So someone is going to share with you. Another question is, are the live recorded classes posted for access? Yes, you can watch, no issue at all. Live revision classes recording is available till this end of this attempt, don't worry at all. So students, let me share the question. Okay. Wait. Okay, let's hear the calculator. Okay, students, in today's class, we are going to discuss a question on APV. But before we start a question on APV, let me give you a little recap for the APV, adjusted present value. APV. Number one, actually, where do we use adjusted present value? There are conditions under which it's better to use APV rather than NPV. Number one, when there is significant debt financing in the project. When we say significant debt financing, significant does not mean 50% plus. You should be thinking around 80%, 70% plus. That is normally we consider significant debt financing. And if you people, I hope you people have seen the lectures on APV. And most of the time, I would say, you will see the question that 100% of the project is financed through debt. So number one is significant debt financing. Another is subsidized interest rate, subsidized loan. Subsidized loan means you are paying interest lower than your normal borrowing rate. So that is loan at a rate lower than normal borrowing rate. That is subsidized loan. Third, there's a possibility of issue cost as well. When we say issue cost, then issue cost could be relating to equity or debt or even both. And when it comes to one more condition, present project or project under consideration, project is in a core or non-core activity. When we say non-core activity, it means I'm talking about diversification. We are doing something different. It means condition number 4, I would say the condition number 4 is fulfilled in every project, because when you are making investment in a core project means in a same line of business, you are making investment, just you're talking about expansion. That is, I'm making investment in the core activity. Non-core activity is diversification. So obviously either your investment is for the expansion or you're going for the diversification. So either you will be making investment in the core activity or you will be making investment in the non-core activity. It means the last condition is always fulfilled, which means that first three conditions are extremely important. Now, where do we use these conditions? Now listen, please carefully, students. If your examiner says, evaluate the financial acceptability of the project, And let's say technique is not mentioned. Should I go for NPV or should I go for APV? Nothing is mentioned. In that case, these conditions will help you, because examiner has not mentioned should I go for NPV or should I go for APV. Then these conditions will automatically help you should you go for APV or not. For example, while reading the question, if you come to know that there's a significant debt financing, subsidized loan is there, issue cost is there, it means you will go for towards APV. Another scenario where these conditions are workable, sometimes what your examiner does, number one, he just writes in the requirement that use suitable investment appraisal technique for financial acceptability. Let's say these conditions will help you and you have calculated APV. Then there is a possibility of another requirement from the examiner for 2 marks, and in which examiner is asking you to justify the investment appraisal technique which you have used. Of course, if these conditions are there in the question, so on the basis of these conditions, you will give the justification that when project is having significant financing side impact, then it is far more logical to go for an APV rather than NPV. Now, next question, what is APV, adjusted present value itself? When we say APV, adjusted present value, logically APV is the combination of two NPVs. APV is the combination of two NPVs. Number one is base case NPV. Okay. Is there anyone who can tell us another name for the base case NPV, which is not a famous name, I know that, but still. A famous name I have written, which is base case NPV. There is one more name for base case NPV, which is not so common, which is not so famous. Is there anyone who can tell us another name for the base case NPV? Base case NPV is a very famous name. I'm just asking, is there anyone who can tell us another name for the base case NPV? No one? That's a little bit surprising for me. Another name for the base case NPV is, okay, let's see, someone has written. Great, NPV of investment. NPV of investment. Okay, so now listen. While calculating base case NPV, we assume that project is 100% equity finance. Repeat. While calculating base case NPV, we make an assumption that project is 100% equity finance. When we are making this assumption while calculating base case NPV, or you can say NPV of investment, that project is 100% equity finance. So always remember then, for base case NPV, logically your WACC is KE. And more precisely, the KE is actually KU, cost of equity of ungeared firm. Because while calculating NPV, base case NPV, we are making an assumption that project is 100% equity finance. It means that I'll be using KE as cost of capital for base case NPV. And one more thing, when we are assuming project is 100% equity finance, now try to understand. Either there is an expansion, means making investment in core activity. What are you going to do? I will take existing beta equity of our own company. I'm going to convert that to beta asset. And logically, this beta asset will be used in capital asset pricing model to calculate KE. Why we are doing this? If I'm making investment in core activity, I'm going for expansion, I'm making investment in my existing industry, I'm not doing something new, then logically my business risk will not change. Plus, I'm making an assumption that 100% of the project is financed through equity. So what now in capital asset pricing model, while calculating KE, I'm not supposed to use equity beta, because equity beta is a measure of two risk beta. It measures your business as well as financial risk. But when we are assuming project is 100% equity finance, it means we are not facing any financial risk. That is why we have to first de-gear our existing equity beta to calculate beta asset. Then in capital asset pricing model, students, you will be using beta asset in CAPM to calculate KE. Now there's a possibility of diversification, as we have already discussed. APV can be used in case of core activity as well as when you are going for diversification. Let's say we are making investment in a known core activity. Known core activity means diversification. Known core activity means diversification. Obviously, in case of diversification, first I need to find out the beta asset of the new industry. And normally, how do we get the beta asset of new industry? There are very rare chance is still there that examiner directly gives you the beta asset of the new industry. But normally, I would say examiner is not so nice towards the students. So most of the time, you are the one who will have to find out beta asset of the new industry. Normally, how do we find out the beta asset of the new industry? Examiner will give you a proxy company in the new industry. So what we are going to do, we'll take proxy company equity beta and we will de-gear. De-gear means ungeared. We are supposed to de-gear the proxy company equity beta and convert that into beta asset. Now listen, student. Whatever the beta asset comes, this beta asset will be used in capital asset pricing model to calculate KE. Why we are using beta asset in capital asset pricing model to calculate KE? Don't forget the assumption. The assumption is while calculating base case NPV, while calculating NPV of investment, we are making an assumption that project is 100% equity finance. That is why in capital asset pricing model, we are using beta asset rather than equity beta. So if it is a diversification, read the question nicely. Definitely your examiner will give you the proxy company in the new industry. Proxy company means simply your competitor in the new industry. Take the equity beta of your proxy company, de-gear it and calculate beta asset. Once you have calculated the beta asset, then same beta asset will be used in CAPM to calculate KE. Now, student, I want to say something, but I want everyone to, please concentrate, please. You have to be alert. The concept which I'm going to tell you right now. Listen it nicely. Assuming the question is on diversification, number one. Number two, examiner has told you to calculate APV. Fine. Now we know that while calculating base case NPV, we make an assumption that project is 100% equity finance. And obviously, I need to find out the beta asset of the new industry. Now try to understand. Assuming examiner has given you the proxy company, you have taken the equity beta of proxy company after de-gearing. I'm again assuming that you have calculated the beta asset. Let's assume 1.25. Just assuming 1.25. If your examiner says that beta asset of the proxy company will be increased by 0.2 for you, if examiner says this, so in that case, what I'm going to do, whatever beta asset I have calculated, I will add 0.2 into that. But of course, for that, examiner has to mention. If nothing is mentioned, then whatever beta asset we have calculated, the same beta asset we will be using in CAPM. So you have to be, alert. Normally, examiner does not go into that much detail. But if you come across a question where examiner says, whatever beta asset, let's say you are calculating by using the data of proxy company, it will be increased by 0.2 for this project for you. If this is the case, then whatever beta asset I have calculated, I will add 0.2. It could be any other number. But if nothing is mentioned, then by using equity beta of proxy company, whatever beta asset you have calculated, the same beta asset will be used in CAPM to calculate KE. Okay, now, while calculating base case NPV, when we are making an assumption that project is 100% equity finance, it means that logically, base case NPV only incorporates business risk, because beta asset is a measure of business risk. And in CAPM, we are using beta asset, we are not using equity beta. It means while calculating base case NPV, we have only considered the business risk. While calculating base case NPV, we have only considered the operational risk. Okay. Now, there's a possibility that base case NPV of the project is assuming negative 2 million. There's a possibility that base case NPV of the project is negative rather than positive, my bad, negative 2 million. Okay. As I already mentioned, APV is the combination of two NPVs. One is base case NPV, another is NPV of financing cash flows. The second is NPV of financing cash flows. How do we calculate NPV of financing cash flows? I'll be explaining within one or 2 minutes. But right now, assuming base case NPV of the project is negative 2 million, let's assume NPV of financing cash flow is positive 3 million. It means overall there's a positive APV. And simply, if adjusted present value is positive, then project is financially acceptable because it will increase the wealth of the shareholders. And obviously, if APV is negative, then financially project is not recommendable because it will reduce the wealth of the shareholders. Until unless, if there are any real options associated with the project, then there's a possibility that even APV of this project is negative, APV of the project under consideration is negative, still we are accepting that project because of the real option. Let's say after making investment in this project, there will be a real option of expansion, assuming. So if there are any real option associated with the project and your management believes that, those real option actually they will convert this negative APV to the positive strategic positive NPV. If this is the case, that in the future, when due to this project, we will be getting the rail option and those rail option will be beneficial for the entity. In that case, even you can write in exam that even though APV is negative, but still there is a possibility company might accept this project. Okay, now just try to understand. Let's say the base case NPV of this project is negative 2, which shows that after making investment in this project, actually you will not be generating anything from the operating cash flows. You will be actually losing $2 million. But look at the NPV of financing cash flows, which is positive 3 million. It means that net NPV is positive, project is financially acceptable, but logically this project, which is right now providing you 1 million positive NPV, it heavily depends on financing cash flows. It heavily depends on financing cash flows. In fact, acceptability of this project itself heavily depends on financing cash flows. APV is the only technique which gives you so much detailed information that from operating cash flows, what you will be generating or you will be losing, and how much benefit you are going to get from the financing cash flows. NPV cannot give us such a detailed information. Now the question is, sir, what is the benefit of calculating, let's say, APV, even though APV has given us the detailed information that from operating cash flow of this project, we will not be generating anything, but financing cash flows NPV is so significant that overall APV of this project is going to be positive. So the question is, what is the benefit? There is a benefit because after when you get to know that project is heavily depending on NPV of financing cash flows, then before making the decision, you have to consider other factors as well. For example, in this NPV of financing cash flows, the major factor is a subsidized loan, assuming. Obviously, when you will be having a subsidized loan, you will be paying lower interest on the loan. if your company says that's in NPV of financing cash flows, the main significant factor is the subsidy benefit. And let's say right now, existing government is willing to give you the subsidized loan. Your project is going to have a life of 10 years. And it is, there are, right now, let's assume, existing current government is very supportive. They are willing to give you the subsidized loan. But right now, let's say the environment is of election. And number of parties, they are carrying out the election campaign. And there are chances that the existing government might change. And the opposition party, which has more chances to be elected this time, they are announcing in their election campaigns, if they will be elected, they are going to simply eliminate all subsidized loan contracts. Now listen carefully. If your project is heavily depending on that subsidy benefit, current government is very supportive. They are willing to give you the subsidized loan. But due to election, there are chances the government will change, and the new government is going to simply take all the subsidy benefit from the existing companies. Can I say if this is the case, then there is a possibility after listening to this, I might not make an investment. Because if my project is heavily depending on the subsidized loan, and there are more chances that the new government is going to come and they are already announcing in their election campaign, they will not be providing any subsidized loan. And in fact, loan agreement of the previous government, the new government says that they will be null and void and we will not be providing any subsidized benefit. So obviously, I will not be making that investment. So definitely the project where we have significant financing side impacts, then instead of NPV, it is far more better to go for APV. Now, student, please listen very carefully. The explanation of NPV of financing cash flows. What actually comes in the NPV of financing cash flows? Number one, present value of interest, present value of tax savings from interest payments. Present value of tax saving from interest payments. Obviously, when company is going to make the interest payment, we know that interest payment results in tax savings. So present value of tax saving from interest payment. How do we calculate this? Very simple. I will take the amount of loan, multiply by the interest rate which we are paying, multiply by the tax rate. Logically, loan into interest rate into tax rate gives you the tax saving. Loan into interest rate results in interest payment. Into tax rate, it results in tax saving. Normally, I'm not saying always, normally tax saving will be same every year, normally. In that case, I will multiply this with the annuity factor. Then I will get present value of tax saving from interest payment. And I just said normally tax saving from interest payment will be same every year. That is why to calculate present value, we will be using annuity factor. Okay. Now, for this annuity factor, please, now this is a very important point I want to discuss here. For this annuity factor, you can use normal YTM, normal KD, normal YTM, normal KD means normal borrowing rate. So basically, for discounting of financing cash flows, YTM, KD, and or you can say your normal borrowing rate, you can use as annuity factor. Or You can even use risk-free rate as annuity factor as discount factor for the financing cash flows. Please look at this, what I've written. It means that if any one of the students is using RF as the discount rate for calculating the present value of financing cash flows, so that assumption is perfectly acceptable. If another student is making an assumption that company will be using normal borrowing rate for the discounting of financing cash flows, 100% acceptable. Of course, when someone is taking RF as a discount rate, another student is taking normal borrowing rate as a discount rate for financing cash flows, both the students will have different APVs. That is understood. But the main concept is the assumption, whichever you have made out of these two, both assumptions are acceptable. And who says both are acceptable? Miller and Modigliani, because they have invented this technique. So sometimes what happens is student, they just get confused for no reason, because sometimes what happens, you are practicing, let's say APV questions, and you have done 3 to 4 questions, okay? Assuming in each question examiner was taking normal borrowing rate as discount factor. But in question number, let's say 4 or 5, you just saw that examiner, instead of normal borrowing rate, examiner has taken RF as a discount rate. So please don't get confused. You can make any one of the assumptions out of these two. Your assumption is 100% acceptable. This is the concept. Okay, now. This is how we calculate present value of tax saving from interest payment. Another point is present value of subsidy benefit. Okay. Post-tax. Present value of subsidy benefit post-tax. Now, first of all, you should be able to you should be in a position to calculate subsidy benefit percentage. Normal borrowing rate. Assuming normal borrowing rate is 6%, okay? And government has given you the loan, or you can say the government is willing to give you the loan at, let's say, 2%. Assuming RF in the question is 3.5%. An examiner says government will give you the subsidized loan. And let's say examiner says subsidized loan rate will be 1.5%. Let's say even lower than RF. Examiner is not directly giving you the subsidized rate. Examiner says subsidized loan rate will be 1.5%. Lower than risk-free rate. It means that subsidized loan rate. Can I say then subsidized loan rate will be 2% for me? Yes or no? Please, student, reply. If examiner says subsidized loan will be 1.5% lower than risk-free rate, can I say then it be subsidized loan rate is 2%? Is this clear to everyone? Let me repeat. If your examiner says subsidized loan rate is assuming 1.5% lower than the risk-free rate, and right now let's say the risk-free rate is 3.5%, then can I say subsidized loan rate is 2%? Now I have a question, student, please reply. If the everything is in front of you, normal borrowing rate is 6%, RF is 3.5, and the examiners says that you can get the subsidized loan even 1.5% lower than risk-free rate. My question is, can you tell me the subsidy benefit percentage? Students, in this example, what will be the subsidy benefit percentage? Excellent, 4%. Because my normal borrowing rate is 6. Perfect. My normal borrowing rate is 6% and subsidized rate is 2. So the benefit is 4%. Great. So subsidy benefit is 4%. Okay, now I'm just bringing the amount of loan. Assuming loan is 80 million. Tax rate is, let's say, 20%. We know that normal borrowing rate is 6%. Project life 4 years. Okay. Part A, tax is paid in the same year, means there's no delay. Loan is 80 million, tax rate is 20%, normal borrowing rate is 6%, project life is 4 year, tax is paid in the same year, it means no delay. Subsidy benefit is 4%. And we are required to calculate present value of post-tax subsidy benefit. Now, please check how will we calculate. Present value of post-tax subsidy benefit. The loan amount is 80. Subsidy benefit percentage is 4%. Loan amount is 80 million. Subsidy benefit percentage is 4%. Post-tax, after tax, tax rate is 20%. If tax rate is 20%, 1 minus t, it means after tax will be 80%. Repeat. If I'm paying 20% tax, then post-tax is 80%. If the tax rate was 30, I would have multiplied with 70. Present value of post-tax subsidy benefit, what I did, I took loan amount, 4% is subsidy benefit, and logically this is 1 minus tax rate. Okay, now we are paying tax in the same year. We are paying tax in the same year, so I'll multiply this with the annuity factor. Here we'll take the annuity factor for first year, first 4 years, 1 to 4. And let's say I'm doing discounting at a normal borrowing rate, which is 6%. So it means I just need annuity factor of first 4 years at 6%. We know that table is given in the exam for the annuity factor, but you should be able to calculate. 1 minus 1.06 minus 4 divided by 0.06. Let me use the calculator, and I want you guys also use the calculator. Let's see. What is the percentage? Students, I'm getting 3.465. Can you check, please? Is there anyone who can confirm? Annuity factor 1 minus 1 plus I percentage minus n upon I. So I'm getting 3.465. So what are we going to do? Here we'll multiply this with 3.465. Now let me just use the calculator. 80 million into 4% into 80%, then into 3.465. Students, I'm getting the answer 8.87. Present value of post-tax subsidy benefit. Loan subsidy benefit percentage, 80% is actually representing 1 minus tax rate, then annuity factor. Right now we are doing discounting at normal borrowing rate. Again, the same thing. If any one of us does the discounting at RF, risk-free rate, it is 100% acceptable. Student, is this clear to everyone? 8.87. I hope this calculation is clear to everyone. Please reply. Students, I'm waiting. Is this clear to everyone? Okay, there's just one or two students, they are replying. Okay, come here. Tax is paid in the same year. Everything is same. Everything is same. Everything is same. Part B. Just one change. Tax is paid with a delay of 1 year. You are required to calculate present value of post-tax subsidy benefit. Everything is same. There is only one change. The change is now we are not paying tax in the same year. We are paying tax with a delay of 1 year. I want every one of you to calculate present value of post-tax subsidy benefit for me. I'm giving 5 minutes to everyone. Please attempt this. You have 5 minutes to give me the answer. What I'm asking, I need present value of tax. I need present value of post-tax subsidy benefit. There's only one change, the tax we are paying right now with a delay of 1 year. So far, one student has given the reply, has given us the answer 9 point, I think it was 59. What about others? Everything is same in the data. There's only one change. The change is tax is paid with a delay of 1 year. Students, whenever there's a tax paid in delay, so it is advisable then you should calculate present value of post-tax subsidy benefit in 2 steps. First, you should be calculating present value of subsidy benefit, and second, separately you should be calculating interest payment. Let me show you how. Present value of subsidy benefit. Logically, company will have the benefit in the first 4 years, but tax will be paid from year number 2 till year number 5. So present value of subsidy benefit is equal to loan, which is 80. Subsidy benefit percentage is 4%. Now I cannot directly calculate, I cannot do it 1 minus t. Why? Because we are not paying tax in the same year, we are paying tax with a delay of 1 year. So present value of subsidy benefit loan into subsidy benefit percentage into annuity factor, which we have calculated. 3.465. Calculator. Okay, sure. Let's see. I'm getting 11.088. Now we'll be calculating separately present value of the tax payment. Present value of tax payments on subsidy benefit. Loan amount is 80. Interest rate is 4%. Tax rate is 20. And tax is paid with a delay of 1 year. So logically, your annuity factor will be from 2 till 5. It will not be 1 till 4. So how will we calculate annuity factor for 2 till 5? First, take the annuity factor of first 5 years. 1 minus 1.06 minus 5. So let me use the calculator. Students, I'm getting 4.212. Okay. Now simply deduct the discount factor of year one at 6%. 1 upon 1.06 will give you the discount factor of the first year. 0.943. So here comes the annuity factor from 2 to till 5. 4.212 minus 0.943. I'm getting 3.269. So 80 into 4% into 20% into 3 point. So 80, then 4%, then 20%, then 3.269. I'm getting 2.09. 2.092. Okay. So 11.088 minus 2.092. 11.088 minus 2.092. So 8.996. Student, is this clear to everyone? Quickly reply, please. In this case, logically, you have to calculate separately. Logically, the subsidy benefit is in first 4 years, but tax is not starting from the first year. Tax will start from the second year. So what we did, we first calculated the present value of subsidy benefit for the first 4 years. Then we calculated the present value of tax payment from 2 till 5. I hope it is clear to everyone. Please reply quickly before we move to another concept. Please, friend, I'm waiting. Okay. Now one more thing. Let me just write. Assuming there's a bank loan of 60 million. This is a question, subsidy benefit is not 2%. How come subsidy benefit is 2%? Please come in. Normal borrowing rate is 6%. Subsidized loan rate is 2%. So the benefit will be 4. Yes or no, please? It is clear now? Okay. Assuming bank loan is 60 million. Project life is 3 years. Bank loan interest rate is 8%. Tax rate is 30%. Tax is paid in the same year. Tax is paid in the same year. Bank loan is 60 million. Project life is 3 year. Bank loan interest rate is 8%. Tax rate is 30, which is paid in the same year. Okay. Bank loan is repaid in 3 annual equal installments. required present value of tax savings from interest payments. Bank loan is 60 million, project life is 3 years, bank loan interest is 8%, tax rate 30 paid in the same year. Bank loan is repaid in 3 equal annual installment. And I need present value of tax saving from interest payment. I'm giving you guys 5 minutes, please. I want everyone to attempt this. You have 5 minutes. Okay, let's try together. Number one, if any one of us who did this 60 divided by 3, you will get 20. Unacceptable. If you are paying 20 million every year, then where is the interest payment? If you're paying 20 every year, then within 3 years it will become 60. So it's incorrect. Logically, your total payment within 3 years will be more than 60 million. So what should be done? How will you calculate annual payment? Simply the amount of the loan divided by annuity factor at 8% for 3 years, because project life is just 3. 1 minus 1.08 minus 3 divided by 0.08. Let's see what I'm getting. Students, I'm getting 2.577. So logically, 60 divided by 2.577, that will give you the annual equal payment. 60 divided by 2.577. I'm getting 23 point, let's say 283 with a little bit rounding off. Obviously, 23.283 multiplied by 3, you will get answer more than 60. So obviously the amount which is more than 60, that represents, that shows the interest payment. Fine. T1, T2, T3. Loan. Bank loan. Obviously, at the start of T1, your bank loan is 60. On this 60, we'll pay the interest 8%. 8% of 60 is 4.8. Less annual payment. Annual payment is 23.283. 60 plus 4.8 minus 23.283. 41.517. Logically, the closing loan is 41.517 at the end of T1. So it becomes opening loan for the second year. Now we'll apply 8% on that. So interest payment is 3.32. Annual payment remains same due to equal annual payment. 41.517 plus 3.32 minus 23.283. 41.517 plus 3.32 minus 23.283. I'm getting students 21.554. Closing loan of T3 becomes opening for the closing loan of T2 becomes opening for the T3. Now we'll apply interest rate on that. 1.7243, and approximately your answer should be 0. If there's a little difference, it is 100% acceptable. Let's see how much difference we are getting. 21.554 plus 1.7243 minus 23.283. So students, the difference is negligible. You can check. Okay, now we have calculated the interest payments. 4.8, 3.32, 1.7243. Tax rate is 30%. Tax rate is 30%. Here comes your tax savings. 4.8 into 30. 1.44. 3.32 into 30. 0.996. 1.7243 into 0.3. 0.51729. Discount factor, the normal borrowing rate at 8%. 1.08 minus 1 for second year minus 2 for third year minus 3. 1.44 into 1.08 power is minus 1. I'm getting 1.333. Okay. 0.996 into 1.08, the power is minus 2. 0.8539. 0.51729 into 1.08, the power is minus 3. I'm getting 0.4106. Now let's add all of them. 1.333 plus 0.8539 plus 0.4106. Students, I'm getting 2.5975. I hope the entire calculation is clear to everyone. Quickly reply, please. Interest payments, then multiply by tax rate, they give us tax savings and then discounting. Now we cannot apply annuity factor here because tax saving is different every year. Tax savings are different every year. Yeah, it's up to you whenever you are multiplying with the tax rate. But the main thing is you should be getting the same result. As far as you're getting the same result, it's okay. You can even multiply 30% and the discount factor together. Okay, now student, let's come here to the question. So it was I would say a really brief recap of APV. Now let's read the requirement first. Azan is sounding right now, just 1 minute break only. So let me hold the video. Okay, students, let's read the requirement. This question is from the pre-seen mock of March 25 attempt. Calculate the APV for the project and evaluate whether investment should be accepted or not. We need to calculate APV. And plus, we have to mention, should we accept the project or not? Obviously, if APV is positive, we should be accepting the project. If APV is negative, we are going to reject the project. Show all the relevant calculations, 13 marks. Discuss the factors which will influence fluff tech companies' credit rating. Evaluating the extent to which these will also be important to its shareholders. Students, please listen the part B first, then I'll come to this A. Discuss the factors which will influence fluff tech companies' credit rating. The factors they affect the credit rating. Number one, earnings protection. Now, what do you mean by earnings protection? Those organizations, they are diversified, they have protected their earnings through diversification. They will attract a good credit rating. Now, the first question is, what do you mean by protection of earnings? Basically, when you are running a diversified business, then there is a possibility that one of the industry is in one of your business in a particular industry is not performing well because let's say overall industry is not performing well. But there are chances that rest of your business might be performing well because your each business is in a different industry. So more or less you will be earning the same amount. So through diversification, let's say you have protected your earnings. So if you have managed to protect your earnings, then obviously it will have a good impact on your credit rating. Then definitely it will boost the confidence of the shareholders to invest in that organization where earnings are protected. So one is earnings protection. Second, people they are sitting in the management. So who are the people they are sitting in your company's management? Their qualification, experience, how many projects they have successfully, let's say, completed in the past, how many projects they are presently running them. So basic, and what is actually overall basically experience, qualification, past record of your management. For example, qualification is the required qualification they have. They are experienced. They are so experienced that they can run a diversified business. They're so experienced they can actually launch and make any product successful. In the past, they have run many projects successfully. Right now, there are a number of projects on which they are working. So if this is the case, then automatically it will have a good impact on your credit rating. And again, shareholders will have more confidence on your organization. But on the other end, you can obviously think negatively as well. If people in the management, they're not so experienced, they're not so qualified. Previously, they did not run many projects successfully. The ratio of the success and failure ratio is more than the success ratio. It means that whenever they will be making investment in the new project, so definitely there will be chances of the failure as well. And shareholders, they will have a doubt when they will be making investment in the new project. In that case, they will attract a bad, I would say, credit rating, and they will also lose the shareholder confidence as well. Now let's talk about gearing loan. If XYZ organization is already a highly geared organization, okay, and let's say they are seeking more loan. So number one, assuming you are already a highly geared company, you are already having a really big amount of loan is already there in your financial statements. If you're seeking more loan, one, it will be difficult to take more loans. Second, still, if you have managed to get the more loan, you will have to pay more interest because your company is a riskier company. So you will end up by paying more interest rate. So already highly geared, going for more loan. One, they will be having difficulties in raising the loan. And second, if they manage to take the loan, they will end up by paying a higher interest rate. And that will attract their credit rating will be poor. It will have a bad impact on their credit rating. And definitely, shareholders will not be happy as well, because when your financial gearing increases, the financial risk increases. Who bears the financial risk? Shareholders. Actually, shareholders, they know that once your company has taken the loan, so you have to make the fixed interest payments. No matter either you are earning or not, you will have to pay the interest payments. So basically, increase in gearing increases the financial risk for the shareholders, and due to that, returns of the shareholder, they will become volatile. So it means high gearing means will not have a good impact on the credit rating, and definitely it will not have a good impact on the confidence of the shareholders as well. There are other factors as well. Let's talk about even a political environment. You are running a business, you are running a company in a country where there's a political instability. Obviously, when there's a political instability, it has a bad impact on every business. It will not have a good impact on few business and good and bad impact on not. Generally, it will have a bad impact on all the businesses. And generally, when there's a political instability in the country, so definitely organizations, they will not be having a good credit rating. When there's political instability, when the your government is not having the good relationship with the neighbor countries, it impacts not only the government, it impacts each and every company in that particular country. So automatically the rating of, I would say, entire country deteriorates. It's not only the organization's credit rating. So it means political stability is very important for the prosperity of the businesses, and political instability obviously creates problem. So it means that when we are just discussing the factors they affect the credit rating, so let me repeat. Number one was earning protection. I've explained what to discuss in earning protection. Then management, people that are sitting in your organization, their experience, their expertise, qualification, how many projects in the past they have done it successfully. Then obviously gearing. If business is already highly geared, you are looking for the more loan, it will have a bad impact on your credit rating. Then another problem is, let's say, the profitability of the company. If profitability is deteriorating, let's say every year, so obviously it will have a bad impact on the credit rating, as well as you will be losing the shareholder confidence as well. Another point is obviously the industry factors as well. If you are operating in an industry which is right now at recession, the industry is facing the recession. So obviously it will not have a good impact on your company. And I've already discussed political factor as well. And one more thing, it's not only the financial gearing. Operational gearing is also plays a key role on this credit rating. Basically, operational gearing means what is the fixed operating running cost of your company. If you are having a very high fixed operating cost, it means your operational gearing is very high, which means that if you are having any issue in the earnings, you will end up by facing the loss. Why? Because you are already having a very high fixed operating cost. So students, there are multiple factors you can write. And let me tell you one more thing. They're asking us the factors they affect the credit rating. So earnings protection, management, political stability, gearing, profitability, industry. All these factors, they contribute in the credit rating of the organization. And it is not necessary that you have to exactly write what examiner has written. They've just asked you what are the factors that influence the credit rating. So as far as you are highlighting the factors which you are highlighting, they are logical, you will get marks. You will get marks. So I have discussed part B with you. You can just write in your own wordings. Okay. For example, let's talk about the earnings protection. You should be able to write 3 to 4 lines on earning protection. You should be able to write 3 to 4 lines on management. You should be able to write 3 to 4 lines on political stability, instability. You should be able to write 3 to 4 lines again on gearing, financial gearing, operational gearing. So if, for example, if you have highlighted 5 points and each point, if you can write around 3 lines, 2 to 3 lines, that's more than enough to get 7 marks. 7 marks does not mean that you have to bring up the 7 valid points, 7 headings, even 5 headings with the explanation, one heading with the explanation of 3 lines. And if you go till 5 headings and each heading you are explaining in 2.5 line to 3 lines, it's good enough. In part A, we have to calculate APV. But student, before calculating APV, I have to take a prayer break. So we will resume the class within, I would say, 20 minutes. So within 20 minutes, inshallah, we'll resume the class. I have shared this PDF in your WhatsApp group. Meanwhile, if you want, you can try part A. Otherwise, within 20 minutes, we'll resume the class. And before resuming the class, I'll drop the message in your respective WhatsApp groups. Okay, students, we are just required to calculate APV of this question. The following exhibit available on the left-hand side screen, company information, new product information. This information should be used to answer. Choose in response. Basically, numerical part we answer in the spreadsheet and theoretical part we answer in the MS Word. Flufftick Company is a company that manufactures electronic parts and large items of electronic equipment. Flufftick Company's profits have been steadily increasing since it was incorporated, and it has always kept its operating costs under control. Great. It was listed on its stock exchange 2 years ago. A large, okay, Flufftick Company's profit have steadily increased. Always remember one point. If the profitability of a business is increasing every year, it means then your stakeholder, they do have the expectation from you that in the future the trend will continue. And you have got the listing on the stock exchange just 2 years ago. Now always remember one point. Those organizations, they're listed at the stock exchange. So they are more, I would say, those organizations, they are listed on the stock exchange. Obviously, there are a number of benefits when you are listed at the stock exchange, but there are problems as well. Because if the political environment in XYZ country is not good, then it has the impact, and it will have a bad impact on the stock exchange of that organization, and it affects all the companies that are listed on that stock exchange. Flufftick Company listing results in an increase in the number of shareholders with a new investor, including some institutional shareholders. Institutional shareholder means, for example, banks. So we are talking about the big players. Example, banks. They have also invested in your company. In a recent meeting with the directors of Flufftick Company, its institutional investors said they were content with its profit increase in the last 2 years, but wanted Flufftick Company's director to pursue investment in a new products and markets to broaden its customer base and increase more profit quickly. So they're talking about we should go for the diversification. Okay, and but wanted Flufftick Company directors to pursue investment in new products. When we are going to the new products, new market, it means we are talking about diversification. Flufftick Company's board is considering how to finance future investment in the longer term. Flufftick Company's chief executive believes that companies should take advantage of its listed status and issue loan notes. Obviously, you are listed, you can issue the loan notes. He understands that the terms on which the loan notes will be issued and the likely success of the issue will be determined by the lifted company's credit rating. Always remember one point: the better the credit rating of the organization is, normally that company will pay lower interest rate. Repeat. If the company's credit rating is good, then they will be getting a loan at a cheaper interest rate. He wants to understand the extent to which the factors that influence credit ratings will be similar to the factor influence shareholders' opinions of the lifted companies and its management. Lifted companies board is currently considering proposal for a new investment in the communication units with immediate expenditure of 160 million. So that's going to be your initial investment. The investment will also require an immediate investment in working capital 20 million. The working capital requirement can be expected to increase annually at the start of year 2 to 4 by the following expected rate of inflation for those years: 8, 7, and 5. It means working capital requirement is not constant. It is changing every year. So just a minute, let me show working one here. Working one, let's deal with working capital. We know that whatever we invest in the working capital at the end of the project, it will be recovered because working capital can never be consumed. Basically, we're going to invest immediately how much? 20 million. We're going to immediately invest 20 million. And then this 20 will be increasing in year 2 by 8%, then 7, then 5%. Okay. 20. If I increase this 20 by 8%, 20 into 1.08, I'm getting 21.6. Now multiply this 21.6 by 7%. I'm getting 23.112, then 5%. I'm getting 24.267. Now, working capital / recovery. Obviously, for T1, you have to make investment at time 0. Then from 20, we are going to 21.6. So additional 1.6. Then from 21.6, we are going towards 23.112. Let me see the difference. 23.112 minus 21.6. I'm getting 1.5 with a rounding of 1. Then 24.267 minus 23.112. I'm getting 1.155. And at the end, whatever we have invested, it will be recovered. 24.267. Students, I hope this working capital working is clear to everyone. Can you reply, please? Never forget one assumption: whatever we invest in the working capital at the end of the project, it will be recovered. At the end of the project, it will be recovered. So simply, this was the working capital. Working capital is fully recoverable at the end of year 4. Okay. The finance director has used a time horizon of 4 years and has forecast the following post-tax cash flows from the investment. These are the post-tax cash flows. Okay. The realizable value of the investment can be assumed to be 0. So realizable value is 0. Don't think for any scrap value. Fluff company's board is considering the following financing package for the investment. Equity issue is 60. Bank loan repayable in equal annual installment over the project life, which is 4 years. Interest estimated to be payable at 8% per year. Fluff company's current cost of borrowing. 8% also shows the current borrowing rate. Interest is calculated on the balance outstanding at the start of the year. Okay, subsidized loan from the government loan scheme over the project life. Interest payable at the rate 50 basis point below the risk-free rate. Now listen. Risk-free rate is 3.2%. Subsidized loan is, you will get even 0.5% lower than 3.2. Risk-free rate is 3.2 and question says your subsidized loan, even it will be 50 basis point lower than the RF rate. 3.2 minus 0.5. Students, I'm getting 2.7. Subsidized rate will be 2.7. Now try to understand. Normal borrowing rate is 8%. You can check here the current Clifton company's current cost of borrowing is 8%. Normal borrowing rate is 8%. Subsidized rate is 2.7. So the subsidy benefit percentage is 8 minus 2.7. Students, I'm getting 5.3%. Subsidy benefit is 5.3%. Is this clear to everyone? Subsidy benefit percentage is 5.3%. Okay. Issue cost 2% of the gross proceed will be payable on the equity issue on the subsidized loan. So 2% you have to pay on equity plus the subsidized loan on this 130 million. Issue cost 2% of the gross proceed will be payable on the equity issue and on the subsidized loan. Fluff Tick company pays tax at an annual rate. 20% tax is payable in the same year, means no delay. Fluff Tick company's finance director intends to use the APV to evaluate the investment financially. She has calculated all equity finance rate 12%. They have already calculated KE for us. Can I say for calculating base case NPV, examiner has already calculated the KE. So very easily we can calculate at least base case NPV because we know that APV is the combination of two NPVs. One of them is base case NPV. So let's simply calculate base case NPV. Base case NPV. T0, T1, T2, T3, T4. Students' initial investment was 160 million, if I'm not wrong. Examiner has given us post-tax cash flows. Let's check. $32.4, 52.7, then 66 and 56. Okay. 32.4 million. 52.7, then it was 66.9. 56.4. Working capital, we have already done the working. Working capital and recovery. It was 20. And then 1.6, 1.5, 1.6, 1.5. Then it was 1. I believe 155. Let's see. Yes or no? Yes, then recovery 24.267. 24.267. We do not have any other cash flows. 180. 32.4 minus 1.6 gives us 30.8. 52.7 minus 1.5 gives us 52.7 minus 1.5 gives us 51.2. 66.9. 66.9 minus 1.155. Students, I'm getting 65.745. 56.4 plus 24.267. 80.667. KE, they have given us 12%, if I'm not wrong. So 1.893.797712636. Present values 180. 30.8 into 0.893 gives us 27.5. 51.2 into 0.797 gives us 40.8. Then 65.745 multiply by 0.712. 46.8. 80.667 multiply by 0.636. 51.3. Base case NPV. 51.3 plus 46.8 plus 40.8 plus 27.5 minus 180. Students, I'm getting negative 13.6. So base case NPV actually shows that from the operating cash flow of this project, you will not be generating anything. In fact, you will be bearing a loss of 13.6. Okay, now come here. Let me explain the financing side impact to save the time. Issue cost is 2% on equity and subsidized loan. Subsidized loan is 70 million, equity is 60. Now, please, student, try to understand. 60 plus 70, it becomes 130. If 2% is issue cost, then 130 is representing 98%. Repeat. If issue cost is 2%, then this 130 is representing 98%. How will you calculate issue cost 2 upon 98? It will give you the issue cost. 130 multiplied by 2 divided by 98. I'm getting 2.65. Issue cost, I'm getting 2.65. Repeat. How did we calculate this? If 2% is the issue cost, then then logically the investment of 60 and 70 is representing 98%. So 130 multiplied by 2 divided by 98, issue cost is 2.65. Now listen, one more point. Normally we assume that issue cost is financed from internally generated funds, from retained earning of the organization. For this issue cost of 2.65, we are not raising finance externally. So 2.65 is finance internally. So your issue cost is 2.65. Okay. Subsidized loan from the government over a project life. Subsidized loan amount is 70 million. Okay. Subsidized loan amount is 70 million. On this 70 million, we have to actually calculate post-tax subsidy benefit. And I think we have calculated. Can I say subsidy benefit percentage is 5.3? Subsidy benefit percentage is 5.3. So let me just show you the working. We can do the working here. This is, you can say, working 2 for the issue cost. To save the time, I'm just explaining the main area. Working 3. Present value of post-tax subsidy benefit. The loan amount is 70 million into how much subsidy benefit is 5.3%. Tax rate is, what is the tax rate percentage? Tax rate is 20. We are paying tax in the same year. If I take 80%, it will become post-tax. Subsidized loan into the subsidy benefit into 80% is representing 1 minus T into annuity factor. I'm doing the discounting at normal borrowing rate, which is 8%. So we'll be using the annuity factor for the first 4 years at 8%. Let me calculate. 1 minus 1.08 power minus 4. Students, I'm getting annuity factor 3.312. So let me use the calculator. 70 into 0.53 into 0.8 into 3.312. Students, I'm getting 9.83. I'm getting 9.83. Okay. Now we need the main issue in this question is we need to calculate present value of tax saving on interest payment on bank loan. And you will apply the same concept which we have discussed at the start of the today's class. Bank loan amount is 50. It will be paid in 4 equal installments. Interest rate is 8%. So students, what are we going to do? Can I say first you have to calculate annual equivalent amount? Let me show you working 4. Working 4 relating to the question. Present value of tax savings from can I say annual payment? Amount of the loan is 50. Can I say this 50 million will be divided by annuity factor? At 4% annuity factor, we have calculated 3.312. So 50 divided by 3.312, I'm getting 15.09. So you can make it 15.1. So T1, T2, T3, T4. Opening loan amount 50. Interest rate is 8%. Add interest. If you take 8% of 50, it becomes 4 less the payment. Annual repayment is 15.1. Your closing balance is 38.9. Can I say 38.1 closing balance of T1 becomes opening balance of T2? Now we have to apply 8% on 38.9. It becomes 3.1, 15.1. I'm getting 26.9. So closing T2 becomes opening T3. 26.9, 8% of 26.9, 2.2. With a little bit rounding of 15.1, we are getting 14. Then 8% of 14, again, little bit rounding off so that there shouldn't be any problem at all. So interest we have calculated 4, 3.1, 2.2, and 1.1. Tax rate, we know that 20%. Discount factor is 8%. You can take 1.08 minus 1. So simply use the calculator. 4 into 0.2 into 1.08 power minus 1. Students, I'm getting 0.74. 3.1 into 0.2, 1.08. O power minus 2. I'm getting 0.53. 2.2 into 0.2 into 1.08 power minus 3. 0.349. Okay. 1.1 into 0.2 into 1.08 power minus 4. 0.162. Let's add all of them. 0.74 plus 0.53 plus 0.349 plus 0.162. Students, I'm getting 1.78. Now let's calculate APV. Base case NPV we have already calculated. I think it was negative 13.6. Let's deduct the issue cost. Issue cost, how much we have calculated? It was 130 multiplied by 2 divided by 98. 2.65. Add present value of post-tax subsidy benefit. Add present value of tax savings from interest payment. Present value of post-tax subsidy benefit was coming. Present value of post-tax subsidy benefit 9.83. 9.83. It was 9.83. Okay. Present value of tax savings on interest payments on subsidized loan. Students, subsidized loan amount is 70 million. On this 70, we are paying 2.7%. Obviously, when I'm paying 2.7%, it's an interest payment. It also results in tax saving. Tax rate is 20% into annuity factor 3.312. Subsidized loan rate is 2.7%. So 70 million into 2.7 into 0.2 into 3.312. I'm getting 1.25. So let us use a calculator. Minus 13.6 minus 2.65 plus 9.83 plus 1.781 and plus 1.25. Student, final answer, I'm getting negative. It is not necessary that it has to be positive always. We are getting negative, how much? 3.389. We're getting final answer 3.389 negative. Of course, by looking at negative NPV, you can write that APV of the project is negative, which will reduce the wealth of the shareholders. So the project, in this project, company should not make investment. Financially, it is not acceptable, but you have to write other things as well. That before making the final decision, it's better to perform sensitivity analysis on the key variables. Plus, before making the final decision, organization should look for any real options. There is a possibility that this project is this project, which is a loss-making project, if company makes investment in this project, which is a loss-making project, but there's a possibility this loss-making project might open the doors for other project in this new products market, and other projects will give us such a big benefit that existing loss will be recovered from the other projects. So it means you are not just going to write a single line that APV is negative, so reject the project. No, you will be writing that before making the final decision, it's better to perform sensitivity analysis on the key variables. Plus, you will also write that it is also possible that making investment in this loss making project might open the door for the new project in this new new products market, and overall company might get the benefit. And you can also mention few more things. In this question, we have been directly given the KE. So you can write that, and KE was 12, KE is 12%. Am I right? KE is 12%. So you can also write that no information is given how company has reached at 12%, which means that if KE instead of 12, assuming it becomes 10%, then obviously APV from negative, it could turn to be positive. So we do not have enough information how they have calculated 12%. Plus, one more thing, just on negative APV, we are not going to reject the project. We have to see the significance, importance of this project as well. And if you look at the question, it is mentioned in the scenario that your institutional investors, they want you to make investment in new products. So you have to write at least 4 to 5 lines. I hope everything is, one more thing, student, I think I've said this earlier as well. Please listen to me carefully. If you are solving the same question on Excel and you are solving the same question by using calculator, you will not get exactly the same result. Your result will be different. So please, you should not get confused with the different answers. As far as you are logically correct, you will get marks. So just by the, minor differences, some of the students, they just go into panic, which is not good. So as far as you are logical, you are getting marks. And this question was from ACCA Mock March 25. I hope each and everything is clear to everyone. Student, last minute of the class before I end the class, is everything clear to everyone? And then okay, one more thing. We have a student shared the name of number of questions on investment appraisal. And out of those 4 to 5 questions, I think on almost on every question, I've already prepared the videos. If the videos are already there, I'll ask the admin to upload video lecture on those questions which we have shared in the WhatsApp group, so that we will be discussing more recent past papers. Obviously, March 25, a question we have just discussed, it is more recent. Then we'll go towards December 24. So please, last message, do not leave even a single lecture in your live revision folder. If admin is uploading any lecture over there, it means it has importance. And you might have noted one more thing today, that today's class was the longest as compared to the previous classes. As I mentioned earlier also, that slowly and gradually live revision class duration will increase. I'm not in a increasing the days is not good, because every student is busy. So that is why it's once in a week, but obviously we will increase the time as and when required basis. So students, thank you very much. Do give the feedback on today's class. To be very honest, whoever was with me in today's class since start till here, this one class covers almost each and everything on the topic APV. So thank you very much, students. Hope to see you all in the next class as well. Thank you. Do